Okay, very good. Let's start. My name is Ali Mortazavi. I'm the head of training and education at Errante, and today we will delve deep into the fascinating world of Forex. Our goal is to ensure by the end of this session, you will have a solid foundation in understanding Forex basics. During this webinar, I'm going to turn off my camera, then you will have a bigger screen for my presentation. Okay, today we have a comprehensive session planned aiming to demystify the world of Forex. We'll begin to understanding the role and significance of Forex in the global economy, move on to its operational aspects, and delve deep into market structure and dynamics. As we proceed, we will also discuss key market statistics and major participants. Also, towards the end, we will conclude with the strategies for effective trading, and we will have a dedicated Q&A session at the end of this webinar. So please send me your questions as soon as they arise, and I will try to address them at the end of this webinar. Good. Let's just turn on my laser point. Okay, before we go through the core content, let's just spend a moment to understand who we are. Errante is not just an online broker. We are a community-driven platform striving to provide unparalleled services, and our core philosophy revolves around trust, transparency, and building lasting relationships with our clients and partners. This is essential to understand that this webinar doesn't constitute direct financial advice or any recommendation for any particular investment strategy. Always ensure due diligence when making investment decisions, please. And Errante provides this content for informational purposes and aims to offer a comprehensive perspective, but we always recommend traders to do their own research first. And here is our general risk disclaimer. It's also crucial for all participants to understand the risk associated with Forex trading. We know CFDs and other derivatives are complex instruments, and there is a significant risk factor involved. So remember, only speculate with funds you're prepared to lose. With that said, let's move on to understanding the foundational concepts of Forex. Okay, let's start. In order to comprehensively understand the role of Forex, it's imperative that we first situate it within the broader framework of the global economic system. The global economy can be conceptualized as a complex matrix of reliant markets, is fulfilling specific functions and driven by separate dynamics. Here you can see one of the most common categorization of economic markets. Let's start with the goods and services market. This segment is primarily concerned with the exchange of tangible commodities and services, like a consumer making a purchase at a retail outlet. On a macro scale also, this is where nations and corporations engage in international trade. Examples include Japan's automotive exports to the United States, or Italy's luxury fashion products finding customers in China. Then we have the labor markets, serving as the nexus between employers and potential employees. The labor market is pivotal in determining wage levels and employment rates. Whether it's a technology firm in Silicon Valley sourcing software developers, or a healthcare institution in Germany recruiting nursing professionals, the dynamics of supply and demand and skill sets play out here. And then we have the real estate market. The segment is specifically tailored to cater to property transactions. It's an arena where both individuals and institutions engage in the acquisition, sale, or leasing of property assets. I'm sure all of you are familiar with this concept, and such transactions range from residential purchases in urban centers like New York to commercial lease agreement in global hubs like London. Then we have the financial markets, arguably the most multi-faceted of all the financial markets or venues where financial instruments are traded. This includes the stocks, bonds, derivatives, and of course, currencies. The Forex market is a subset of this domain, playing a crucial role in facilitating international trade and investments by providing a mechanism for currency exchange. In summary, each of these markets operates within its own set of parameters, yet they are interconnected in the grand architecture of the global economy, and their collective functioning underpins the economic structure that drive growth, development, and wealth distribution. Each of these markets is a venue where buyers and sellers interact, facilitating trade and commerce. So picking up, sorry, we lost that. Yeah. Picking up from our previous discussion of financial markets, let's delve deeper into the complex tapestry that makes up this vast landscape. As we zoom into the heart of financial markets, they unveil themselves as a collection of 5 distinct pillars, each with its unique character and purposes. Firstly, there is a capital market, the grand whole of long-term planning. Let's picture a majestic building where businesses and governments come to make their future aspirations tangible. Here, companies like Apple might issue shares, inviting the public to be a part of their journey, or the UK government might sell bonds, gathering funds for monumental projects like infrastructure development. Then we step into the money market, the bustling hub of short-term financial endeavors, imagining a lively marketplace where quick decisions rule the day. It's where banks might borrow funds just for a night, ensuring they meet regulatory standards. Okay, our journey then takes us to the derivatives market. Envision a trading arena where the spotlight isn't on tangible assets, but intricate contracts that derive their value from these assets. Whether it's a stock, commodity, or even currency, their shifting values shape the contracts here in derivative market. One such contract is the CFD, or contract for difference. It's the dance of a speculation where you're not buying the asset like gold, but betting on its price movement. The rewards can be high, but so can the risk, given the leverage nature of CFDs. We will cover CFD market in greater details in our coming webinars. And so for now, just let's move on to the other titan. Of course, today's star is Forex market, the grand bazaar of currency exchanges. It's like the heart of our financial city, pulsating with every currency trade, be it a traveler exchanging money for a trip, or a multinational company trading dollars for pounds to invest in new ventures. All of them should participate in Forex market somehow. And lastly, we arrive at the newest skyscraper on our skyline, the cryptocurrency market. It's the realm of the digital, where assets like Bitcoin and Ethereum redefine traditional trading. Whether you're speculating on Bitcoin's futures or accepting Ethereum for a service, this market symbolizes the future of finance for sure. And while each of these markets plays its unique melody, it's the Forex market that stands as a symphonic epicenter in the global financial concert. So as we journey deeper into the financial labyrinth, we arrive at the heart of our exploration today, the realm of Forex. But what you might wonder is this entity called Forex. Forex is standing tall for foreign exchange, is the art and science of converting one currency into another. And this transformation is choreographed by the exchange rate. Picture this. You've been dreaming of that mesmerizing trip to Japan, okay? And so over time, you would gather need a stash of US dollars, but there's a twist. Once in Japan, the monasteries of Tokyo or the serene temples of Kyoto won't accept your dollars. They speak the language of yen. So before you set foot in the lands of the rising sun, you will have to swap your dollars for yen. And there, in that moment, you have danced with the essence of Forex. Clear? Perfect. Now, this exchange isn't the game of dice. The number of yen coins and notes you receive for your dollars is dictated by the exchange rate. Think of it as a currency's price tag. When you hear that the USD to JPY rate stands at 110, it's like a conversion receipt. 1 US dollar magically turns into 110 yen. So exchange rate is the price at which one currency is converted into another. But here is where it gets fascinating. As you're savoring sushi or wandering in amidst cherry blossoms, this rate might ebb and flow, dancing to the tunes of global events, from economic shifts to political drama and even nature's whims. In our travel tale, the US dollar, the currency you started with, is the domestic currency here, and the yen, your key to Japan, is a foreign currency. And this intricate valley between diverse currencies influenced by a myriad of global actors is what infuses life and energy into the Forex world, making it a realm of endless possibilities. Cool, yeah? Let's say, as we advance further into our exploration of the global currency landscape, we are poised to uncover the foundational mechanisms that govern Forex trading. Let's begin with the unique nature of the Forex market. It operates over the counter, commonly known as OTC. But what does this signify? Unlike the stock markets, which rally in grand halls like the New York Stock Exchange, Forex is more intimate. Here, deals are struck directly between parties, be it banks conversing in billions or individuals exchanging a modest sum. It's as if you're sealing a deal over a handshake, no middleman, no grand arena. So this direct approach is a hallmark of Forex's decentralized character. Such decentralization gives Forex its global rhythm, allowing it to dance 24/5, resonating with the world's time zones and financial heartbeats. But a note of cautious, this freedom from a central hub can sometimes lead to minor price variations across brokers. Now, let's stepping into the digital age. Let's familiarize ourselves with the Electronic Communication Network, or ECN for short. Visualize ECN as a bustling digital bazaar. Here buyers and sellers converge not in physical stalls, but in transparent digital lists, displaying real-time prices and ongoing trades. ECN serves as a digital bridge connecting individual traders to the financial titans like major banks, acting like an efficient matchmaker somehow. It pairs buy and sell orders ensuring traders can dance directly to the Forex rhythm. The beauty of ECN is the transparency. Everyone, irrespective of their trade size, has the same view, ensuring fairness in the marketplace. Sorry, just lost my slide. I see. Yeah, I was saying, and with such a system as the ECN, traders often enjoy better prices thanks to the competitive environment ECN fosters. And imagine you as a trader eyeing to buy some euros, okay? In the world of ECN, you are presented with a clear list showcasing all sellers offering euros, and you can pick and choose, ensuring you get the best deal. And in summation, while Forex's OTC charm allows for direct global interactions, the introduction of ECNs further refines this process, offering a transparent and swift electronic stage for the world's currency market. Okay, as we journey further into our exploration of global finance, let's pause for a moment and imagine a utopia in the world of economics. Picture a market known as perfect competition, where prices remain unbiased by any single player, where uh, every trader, big or small, shares the same information, and where stepping into or out of the market is as easy as a breeze. While this might sound like a dream, the Forex market mirrors this utopia closely. Let's delve into the reasons that elevate Forex to this esteemed position. Let's start with numerous participants. The Forex market is a bustling bazaar, teeming with traders, ensuring continuous activity and unparalleled liquidity. Also, uh, yeah, also currency is the universal language here, whether it's dollars or euros. Their essence remains unchanged across the globe. Uh, for that case, thanks to electronic platforms and the absence of middlemen, trading in Forex is often lighter on the pockets. Uh, and then Forex never truly sleeps, operating nearly 24/7 uh, 5, it dances to the rhythm of global time zones in different countries and continents. So impartial prices also is available. The vastness of Forex ensures that no, not even the mightiest banks can sway market prices for long. It's a realm of fairness. And also, we have a crystal clear information with decentralization as its backbone for express price information far and wide, ensuring traders everywhere from Tokyo to skyscrapers to Toronto's uh, streets have the same view. And because of that, we have the ease of participation in Forex market. The doors of Forex are open to all, from all solo trader in their study to giant corporations in their towers. Everyone can join this financial symphony easily. So now, one might wonder, why is this near perfection so crucial? For traders, it's the promise of a fair game. The shadows of price manipulation fade, and success hinges more on skill, strategy, and timely insights than on sure market muscle. It is hard. Forex is a democratic arena where every participant has a unique role to play. So why is the Forex market so significant? Its importance, oh, sorry for that. Yeah, I was saying, firstly, it's the world's largest financial market, ensuring liquidity for international transactions. Imagine needing to buy products from another country. Forex facilitates that transaction by providing the liquidity. Secondly, it's the determinant of currency values, impacting everything from your holiday abroad to the price of your imported car. And lastly, it's the backbone supporting global commerce, allowing businesses worldwide to trade seamlessly by converting their revenues and costs into their preferred currency. Building on these pivotal roles of the Forex market, there are a few more aspects to consider. First, exchange rates aren't just numbers. They're reflections of a country's economic health, stability, and various macroeconomic factors. A strong currency often indicates a robust economy. Also, one thing to bear in mind is the Forex market is not just about currency conversions. Businesses use it to protect themselves from adverse currency movements, while investors find opportunities to profit from price fluctuations. Moreover, central banks around the world utilize the Forex market as a tool to implement their policies. By influencing exchange rates, they can stabilize their currencies and manage inflation more effectively. To truly grasp the Forex markets, understanding its structure is crucial. We can picture it as a three-level pyramid here. In the vast ecosystem of the Forex market, think of the relationship between market makers, brokers, and retail traders as a symbiotic dance, which relying on the other to maintain the fluid and efficient market. Imagine the bustling marketplace. The market makers are the primary suppliers to ensure there is always a stock available. The brokers are the stalls or shops where you, the retail traders, go to buy or sell goods. Now, let's delve deeper into the rules each plays. First, let's start with the market makers. As you see, these are the big players like major banks, and financial institutions. Their main role is to ensure there is always a ready supply and demand for currencies, ensuring liquidity in the market. They stand ready to buy or sell, making the market tick. Uh, their profit mainly comes from the bid offer spread, and they play a vital role in preventing liquidity shortages in the market. Then we have the brokers acting as intermediaries. They connect you, the traders, to the vast Forex marketplace. They provide the platforms and tools for trading and often offer insights, news, and analysis to help traders make informed decisions, like what we're doing right now at Errante with this webinar. And the revenue of brokers typically comes from commissions or spread. And the last but not least, we have this segment, retail traders. This is where individual investors, small businesses, and even some larger corporations come into play, driven by various motivations from hedging against currency risk to, of course, speculative trading. They are the end users of the Forex market, setting the demand, and they drive also the trends in the market. Let's delve into one of the most characteristic attributes of the Forex market. It's dominating global liquidity. Forex is recognized as the most liquid market in the world. To give you some perspective on what that means, the daily trading volume in the Forex market exceeded $7.5 trillion in 2022. Imagine in a single day, transactions worth more than the GDP of many countries combined are conducted. And the market is so vast that it can effortlessly handle trades as large as $1 billion, which is called yard, without breaking a sweat. By But let's say, how does it compare to other markets? Okay, before we get to the what does this mean for us as traders, consider the US stock market, one of the largest equity markets in the world. Its average daily trading volume around $200 billion per day. The global gold market, which has been a cornerstone of wealth for centuries, sees an average daily turnover of about $183 billion. And oil, the black gold that powers our world, its daily trading volume hovers around $180 billion. So comparing these figures, you will see that the Forex market's daily turnover is more than 37 times that of the US stock market. That's the sheer scale we are talking about. So what does this mean for traders and investors? First and foremost, such a deep market ensures that even large trades have a negligible effect on prices. This means that if you as a trader decide to buy or sell a significant amount, the market won't dramatically shift because of your single trade. In a sense, the Forex market stands as the epitome of liquidity and depth in the global financial landscape. Now you might wonder, why does this matter to you? The answer lies in the benefits this liquidity offers. With such high liquidity, trades are executed swiftly with nominal prices discrepancies between where you intended to enter or exit a trade and where you actually do. A phenomenon known as slippage in Forex world. Furthermore, this liquidity ensures reliable price trends, making it easier for traders to make informed decisions. To illustrate, uh, think of the Forex market as the world's largest ocean. Just as a single drop barely causes a ripple in the vastness of the ocean, even substantial trades are just a drop in the Forex ocean, barely affecting the overall flow. So when you are trading Forex, remember you are navigating the most liquid market on the planet, which offers unparalleled advantages in terms of speed, price, reliability, and minimal impact from individual trades. As per data from the Bank for International Settlements 2022 survey, the Forex market has seen a remarkable increase in daily turnover over the years. This rising trend highlights not just the market vitality, but also its expanding role in the global economy. As traders and investors understanding these shifts and trends can offer valuable insights to market dynamics. Having understood unparalleled liquidity and depth of the Forex market, let's now explore another unique characteristic of the global financial giant. It's continuous operation. Unlike most financial markets, which have specific opening and closing time tied to their local business hours, the Forex market is always awake, always trading. This 24/5 trading cycle is made possible by the sequential opening of 3 major trading sessions across the globe. And let's embark on the journey around the clock. Starting our journey in the East, the Asian session kicks off at midnight GMT, running until 9 GMT. It's not just Tokyo. Financial hubs like Singapore and Hong Kong also play a significant role here. Given its position after the weekend break, the Asian session can often see reactions to weekend news events. As Asia starts to wind down, Europe is just getting started and active from 7 to 16 GMT. London, being a major financial hub, sees massive trading volumes, making this one of the most active sessions in the world. And then, as Europe prepares to close shop, The American session takes the clock spanning from 12 to 21 GMT, with Wall Street and other major financial institutions participating. Significant economic news from the US can cause substantial market movements during this period. Now, here is where it gets even more interesting. The market overlaps. The most significant overlap occurs between the Asian and European sessions from 7 to 9 GMT, and between the European and American sessions from 12 to 16 GMT. During these overlaps, trading volume surges as traders from both time zones are active simultaneously, leading to quicker trades and significant price movements. And okay, what about liquidity? One might ask. Liquidity refers to the ease with which assets can be quickly bought or sold without significant price changes. Higher trading volumes typically means higher liquidity, and making the market overlaps especially crucial. The higher liquidity during these overlaps ensures smoother trading experience and tighter spreads. That's this is another trading concept that we will break it down in our next webinar. In a sense, understanding these trading sessions and their overlaps is crucial for traders. By aligning strategies with these active periods, one can capitalize on the heightened activity and the opportunities it presents. Diving deeper into the data, let's look at where most of the Forex trading occurs. Our pie chart here paints a picture of where most of the action happens. Let's cut apart this. With London at its heart, the UK is the undisputed kingpin of the Forex world. Given its time zone, London bridges the trading gap between the US and Asia, making it a hotspot for Forex activity. As a trading tip, I would say, given London's dominance, major price movements often originated here, especially during the overlap with the US session. And then we have the New York. New York comes in second with its financial might and significant economic announcements influencing global Forex trends. So economic data releases from the US, such as non-farm payroll numbers, can cause significant volatility in the whole market, and traders should be aware of the US economic calendar all the time. Also, we have the other notable locations while the UK and the US dominate financial hubs like Tokyo, Singapore, and Hong Kong also play crucial roles, especially in the Asian session. Understanding currency strength during the specific sessions can offer an edge. For instance, the Japanese yen often sees increased activity during the Asian session. Another important data that we can extract from the International Settlement Survey is that the 46 of global FX turnover in 2022 came from the banks. The segment underscores the hefty influence financial institutions wield in the Forex arena. And so we can say institutional trading patterns, often referred to as smart money, can offer insights into potential market directions, and traders often look for signs of institutional buying or selling as potential indicators. In a sense, the geographical distribution of Forex trading isn't just a matter of stats. It offers actionable insights. By understanding where the action is and aligning strategies to the rhythm of these financial hubs, traders can navigate the market with greater finesse. Okay, so how's it going so far, guys? It would be great to have some feedback, if you mind. Thank you. Okay, let's move on and see another market statistic. Currencies are at the heart of Forex, and while there are numerous currencies available, select few dominate the trading landscape. Our chart here offers a snapshot of the behemoths of the Forex world in 2022. At a glance, it's evident that for certain currencies wield more influence than others. Let's break it down. First, you see the US dollar standing tall and overshadowing the rest is the US dollar. This dominance isn't just a testament to the US economic strength, but also to the US's role as a global reserve currency used in the majority of international transactions. So given its widespread use, US pairs are some of the most liquid. Watch out for key US economic data releases. They can significantly impact USD pair. Then we see the EUR/USD as the share of 31% of global FX rates, representing the collective economic might of the Eurozone. The euro takes the second spot. Its significance esteem from the combined economic activities of the numerous countries that use it as their official currency. And then we have the Japanese yen, representing the Asian economic powerhouse of Japan. The JPY is a major player. It's also often used as a safe haven currency in turbulent times. And British pound, as you see, British pound, as you see here, despite the geopolitical problems after Brexit and other challenges, the British pound remains a key player in the region and illustrating the UK's long-standing financial influence. And then we see the Chinese yuan, China's rapid economic ascent in recent decades is mirrored in the rising influence of its currency, while it's still finding its footing compared to longer standing currencies. Its growth trajectory is one to watch. Now, an observant eye might wonder, why do these percentages sum up to 200% instead of the usual 100%? The reason is simple, yet fundamental to understanding Forex. Every Forex transaction involves a pair of currencies, a buy and a sell simultaneously. Hence, both currencies in the pair are counted, leading to a 200% total. And as a practical point for traders here, is that recognizing the dominant currencies and their respective weightages can guide trading decisions. Liquidity, volatility, and opportunities often revolve around these major players. Moreover, understanding the pairing and nature of Forex trades can offer insights into potential currency correlations and dependencies. Our chart here illustrates the titans of currency trading in 2022. These pairs are the lifeblood of the Forex market, with traders around the globe capitalizing on their movements. As you see here, standing at the pinnacle is the Euro-USD pair, often termed the king of pairs, representing two of the world's largest economies. This pair is renowned for its liquidity and is a staple for many traders, because due to its popularity, the Euro-USD often is the best cost-effective choice for trading. Then you see USD JPY with a 13.5% proportion of whole trades in 2022, bridging the East and the West. This pair reflects the economic dynamics between the US and Japan. Its movements can be influenced by geopolitical tensions and shifts in global risk sentiment. So watch out for economic indicators from both nations, especially central bank announcements, as they can induce volatility. And the next one, the USD GBP, known colloquially as cable. This pair has deep historical roots and can be particularly sensitive to political events, especially those related to the UK's ties with the EU. So inflation data and Bank of England decisions can be key drivers for this pair. And then we have a USD EME, means representing the US dollars interactions with emerging market currencies. This segment underscores the increasing influence of developing economies in the Forex landscape. So emerging markets can be more volatile, influenced by both domestic factors and global risk appetite. And the list continues, as you see here, with pairs like USD CNY reflecting US-China trade dynamics and AUD-USD indicating commodities trends, especially those linked to metal and mining. By the way, in conclusion, understanding the weightage and dynamics of these major currency pairs is essential for crafting effective trading strategies. Each pair has its own rhythm, influenced by economic, political, and geopolitical factors. By aligning trades with the ebb and flow of these dominant pairs and staying updated with global events, traders can navigate the markets more adeptly. I hope that in our coming webinars, we can go through all the key events that can influence the particular currency pairs in the market in a much great angle of details. By the way, as we journey further into the world of Forex, it's essential to recognize the key players that shape its landscape. These participants, each with their unique motivations and strategies, contribute to the market's dynamism and depth. Let's delve into the primary actors. As we see, first up, we have the banks, which command a whopping 68% of the Forex world. Both domestic and international banks are truly the giants here. Their activities and multifaceted. Imagine a bank's trading desk. Here, they engage in proprietary trading using their vast reserves to buy and sell currencies, aiming to turn a profit. But banks aren't just trading for themselves. They are also the conduits for customer trading, facilitating transactions for everyone from individual traders to multinational businesses. Moreover, banks play a pivotal role as market makers, like heartbeats, ensuring the market's lifeblood keeps flowing, and they continuously provide buy and sell prices, guaranteeing liquidity in the market. And for the heavy hitters in the Forex game, banks offer prime brokerage services, acting as intermediaries between high volume traders and other market participants. A word to the wise for traders out there. Central bank, holding just 1% of the market, but don't be fooled by the number, please. Their influence is titanic due to their regulatory power. Central banks can be a game changer. They have the power of currency intervention directly stepping into the Forex arena to stabilize and or amplify their currency's value. Moreover, their decision on monetary policy, especially concerning interest rates, can send ripples through the currency values in the whole market. Please attention traders, always stay alert to announcements from major central banks like the Federal Reserves or the European central banks. Their words can stir the waters, leading to significant market volatility. Moving on to the corporates, which comprise 6% of the market. Think of the global giants, companies that have footprints in multiple countries. Their Forex dance is driven by practical means like settling invoices payments in diverse maybe currencies, and they also engage in hedging using Forex tools as shields against unfavorable currency shifts. And of course, they are always on the hunt for cost reduction opportunities, timing their transactions strategically to boost their bottom line. In that case, they participate in the Forex market to take advantage of the vast of opportunities that we have in this market. And here is a nugget for traders. Big businesses move whether mergers or international collaborations can sway currency pairs, especially if they involve hefty currency exchanges. Lastly, holding a significant 25% of the market, you have the speculators and investors. This group is on a mission to capitalize on currency flux. Very simple. Within this category, we find the wealthy HNWIs trading in immense volumes. Then there are the hedge funds employing a medley of strategies, with Forex being one of their arrows in the quiver. And not to forget the prop desks, the in-house warriors of financial institutions, honestly, trading with the firm's capital to snatch direct profits. And for those with an ear to the ground, speculators often spark short-term market waves, guiding both your short-term trades and long-term strategies. You can just capitalize on the sounds of the speculation in the market always. In conclusion, understanding the motivations and the strategies of these market participants is key to navigating the Forex landscape. While the percentages indicate their volume, their influence extends far beyond mere numbers. So guys, so far, if you have any question, please write it down and send it in the chat box, so I will have a chance to review them and maybe address them at the end of this webinar. Cool. Okay, let's moving on. As we journey deeper into the world of Forex, it becomes essential to understand the winds that steer the ship right now. These winds or factors shape the movements of exchange rates, determining the direction in which currencies move. Whether it's the immediate turbulence caused by breaking news events or the steady pull of long-term economic principles, every force has its part to play. Understanding these factors is crucial for traders to make informed decisions, and we can categorize these factors based on their impact duration. In the dynamic arena of Forex, multiple forces act upon tides of currency values. Each force has its rhythm, some creating immediate ripples, while others mold the landscape over a prolonged period. So let's first delve into the short-term drivers. Okay, picture the bustling trading floors reacting to economic news. The release of data, be its unemployment figures, inflation rates, or even GDP growth, can ignite immediate market responses. Imagine the US declaring a surge in job growth. Such news might fuel the dollar's ascent, reflecting a thriving economy, maybe. Then there is speculation. It's the realm of forecast where traders and institutions shift their capital based on whispers of the future, like a breeze caused by rumors of approaching interest rate changes, speculation can nudge a currency this way or that. And then interest rates to have their dance in the short-term play. They offer tantalizing arbitrage opportunities, attracting foreign capital like a magnet. And uh, picture a European central bank announcing a rate boost. The allure of better returns could empower the euro for sure. And let's not forget art and science of technical analysis here. It's where traders become fortune tellers, reading the price patterns and trends, making moves based on the stories these patterns tell. Journeying forward, we enter the realm of medium-term influences. Here, trade plays a pivotal role. The delicate balance of imports and exports casts shadows on the currency's value. Envision Japan is ports bustling with exported cars, reporting repeated trade surpluses. Such momentum could elevate the yen over several moon cycles. And then investments, particularly direct foreign bonds, are also key players on this stage. Visualize a global company pouring investments into a nation, buying vast amounts of its currency, pushing its value to new horizons. And the puppeteers of the Forex world, for sure, the central banks often step on the stage with their interventions, molding currency values to their notions. Imagine the Bank of England accurately buying pounds, orchestrating a symphony of appreciation. But it's not the end of this story. As we sail into the vast ocean of long-term determinants, we encounter the principle of purchasing power parity, or PPP. It's the cosmic balance of the Forex universe, ensuring that a dollar or euro holds similar weight in buying power across the globe. Consider a basket of goods priced at 100 in the US and 85 euros in Europe. Over time, the cosmic scales might tilt, moving the exchange rate to reflect this balance. In understanding these forces, categorized by their duration, traders find their compass. It guides them whether they are in for a brief adventure, a month-long expedition, or a lifelong journey in the world of Forex. So all different types of traders for sure can use uh, these factors for a short-term decision, mid-term decision, or their long-term investment decisions in Forex market. However, we explored what moves exchange rates. Now let's understand how we can use this knowledge to make smart trading choices. At the heart of this is market analysis. Traders have a few key tools to help them make decisions, and let's break them down. First, there is fundamental analysis. Think of it as understanding the big picture. It's about looking at the country's economic health, things like its economic growth, interest rates, and even political stability matter here. If a country is doing well economically, its currency might go up. Next up is technical analysis. This is like reading a currency's diary. By looking at past prices charts, traders try to predict what might happen next, and they use tools and patterns to help them spot trends. Then we have sentiment analysis. It's about understanding the mood of the market. What are other traders thinking and feeling? If most traders believe a currency will go up or down, it often does. This is because their trading decisions are based on these beliefs. And lastly, there is the carry trade analysis. Here is a simple way to think about it. Some countries have higher interest rates than others, okay? So traders can borrow money from a low interest rate country and invest it in a high interest rate company. The difference is in the rates can be a profit. But remember, there is always a risk of currency prices because currency prices might change and affect the profits. So whether you're just starting out or have been trading for a while, these tools can help guide your decisions. With the right analysis, you will be better equipped to navigate the exciting world of forex trading. We will break down these methods into a great degree of details to explore how we can include them in our trading practice, hopefully in the future. Okay, in our upcoming webinar, we will dive deep into essential trading concepts, blending theories with hands-on practical insights to empower your trading journey. For today, thank you for your attention so far. And now I'd like to open the floor to any questions you might have. Please don't hesitate to ask anything, whether it's about the factors influencing exchange rates, analysis methods, or any other topic that we covered today. Very well, no questions so far. So uh, let me just wrap it up. It's been a pleasure discussing the basics of forex trading with you all today. Remember, continuous learning is the key to success in this field, and stay tuned for more webinars and sessions to deepen your understanding and improve your trading skills. Thank you, and best of luck in your trading journey.